Distinguished guests, dear IBPC members, welcome and greetings. Welcome to this webinar, which is part of our flagship series, India Dialogues, where we have had distinguished personalities in the past being featured. Today, we are happy to feature and welcome Mr. Manish Chokhani, whose profile has been circulated to all of you. So I will not dwell too much on in terms of introduction, but he's clearly a thought leader in India, well respected, often on the media, especially the business and economic media. And his pronouncements are watched closely by the policymakers in India. So we're happy that we're featuring Mr. Manish Chokhani as part of the India Dialogue series, which, as you know, is solely sponsored by Emirates and BD. So Manish, welcome to Dubai and IBPC virtually. And I was hoping that perhaps you can start with any PowerPoint presentation that you may want to make and walk us through it, and then we can follow it up with a quick dialogue in terms of a Q&A session.
Sure.
And also invite questions from members after they have seen and heard you in terms of a PowerPoint presentation. So over to you, Manish.
Thanks, Suresh. It's fun to be, like you said, in Dubai, even if it's virtually. And I gather that things are already kind of back to normal over there. So that's good to learn. So when I was given the brief, I was told that people are, well, they may have some connection to India because of maybe a lot of people being born here or having family connections, but not necessarily doing a lot of business with India. And maybe it would have been useful to then therefore share what is exactly going on in the country and giving some sort of a sweep of the backdrop in which the country is operating. So that's what I've attempted here. And like with most things about India, it's always like Ruchir Sharma very famously has said that it's a country that consistently disappoints the optimists as well as consistently disappoints the pessimists. And I think that's the sort of summary of really what I'm going to share with you today. I'll launch straight into the presentation, and it's about 30 odd slides. So I'll try and finish in about 45 minutes, and then we can have some room for Q&A. This, of course, is a slide every Indian is kind of haunted by, because if you, I hope you can see it.
Yes.
If you go back in history, India and China basically were about 1/3 of global GDP, as recently as maybe 300 years ago, before, the steam engine and the industrial revolution came about, and these two giants missed that trick. And they did not participate in that industrial revolution, which led to really the rise of Western civilizations. And they eventually got squeezed out. And I think India went from more than 30% of global market share to as low as 1.5 or thereabouts at the time it achieved independence, in the late 1940s. And it continued in that same kind of socialist way until the early 1990s, when it started reforming. And then, of course, there's been some expansion in the economy, not satisfying enough by the yardstick of all of us in India. And in the same period, of course, you saw China galloping ahead and becoming almost, I think now, the only power which in a sense is competing with the US. So this is the sort of potential which the country holds, and it's been consistently performing below its potential. Having said that, if I take the sweep of the last 30 years, the GDP has actually grown up by almost 10 times, and it's close to a $3 trillion GDP. The per capita income, of course, rose only 7 times, while the GDP grew 10, because the birth rate did not go down. And, as people got prosperous, the birth rate went up rather than going down, as you've seen in other parts of the world. But hearteningly enough, the linkages with the rest of the world multiplied dramatically, and they went up almost 20 times in the last 30 years. And of course, for people like myself who are, investors and investment bankers, the more relevant number was that the market cap, which was a very unbelievable $45 billion, expanded more than 30 times. It's actually probably still north of this but let's just argue it's, kind of 30 times. And policymakers continue to be haunted by the fact that India had run out of foreign currency reserves to pay for its imports, and it had actually had to pledge its gold. And I'll cover this a bit later. This seems to explain the phobia that the Indians have to create foreign currency reserves and hold it. Even at a time when the world is kind of gushing with liquidity, India hasn't really been able to participate in that. And of course, saving rates, investment rates have all remained very robust, and the country's grown, as these figures show you. I'll do 3 or 4 slides to give you context that it is now among the 5th largest economies in the world. And it is slated, of course, to become the 3rd largest and cross Japan over the next decade. Having said that, when markets are more forward-looking, they haven't priced this rate of growth because they haven't seen that level of innovation or growth or regulation changes which one would have expected. So normally a country which would have been 5th ranked by turnover or GDP and expected to rise to the rank of number 3, you would have expected the market to discount it forward, and probably the ranking should have been 3 or 4 or even 2. And yet India is probably only ranked number 9 in the world. And that should give you a signal to, that we aren't yet doing all the things right. To put some figures just for, back of mind, assessment, it is a very large economy. It is producing almost, number 1 or number 2 in terms of most agricultural produce. It has ample of water, it has ample of farmland, it has ample of farmers, and therefore it's not been held hostage to any external countries when it came to, for example, the COVID crisis. It had complete control over its food supply and seems to be doing okay on that front, although productivity is an issue. On infrastructure front, I'm sure when most of you land, you've grown with the quality of the infrastructure. But in terms of sheer size, as you would expect for the 5th largest economy, the infrastructure is actually there to cater to a country of this size. It obviously needs to be upgraded a lot more. And especially in things like aviation, which people had seen as a growth sector as people would shift more and more towards airlines away from the old Indian railways. There is a lot of excitement, although it's been completely punctured by what happened with COVID. But just going back a few years, almost every airline in the world was vying to come in, and including people who did come in and form joint ventures. They were doing fairly well as they edged out the old national carrier. But all these are slated to get privatized as we go ahead and as the government runs out of policy options. So there will be, of course, opportunities here, which a number of countries from the Middle East are, of course, very aware of and working closely now with the sovereign wealth funds from those countries. On the industrial base also, as contrary to what people think, it is actually a very large industrial powerhouse. And while China is in a league of its own completely, I've just put some statistics here to compare with, Japan and US, which are number 1 and number 3 countries. And in almost every space, India is kind of going ahead of them in terms of at least capacity and certainly on a cost base. So there is, good hope that as the world kind of changes with the geopolitics, which is playing out post-COVID, there is some opportunity for India to step up and get into that game as well. This is again the half glass empty, half glass full kind of situation where the country is producing 32 million graduates a year, 9 million postgraduates a year. So there is a large, workforce coming. And yet, when you actually hire them, the complaint often heard is that they are not job ready. And the flip argument also applies that for these 9 million people, there aren't enough those quality of jobs available. So the potential to grow and the potential for having skilling is far greater than what you would see over here. So while, that's, a reasonably okay last 30 years, the next part of the presentation really is talking about what we still have to do. And this is the part where you can either see it as failure to deliver or an opportunity which one can harness. And as an entrepreneur or a businessman or an investor, you would tend to think that there are places where if you think and read between the lines, there is something to be done over here. And pardon me, there is some macroeconomic numbers which I have to put up. And it may be kind of boring at 7 o'clock in the evening in Dubai, but it'll help to frame the kind of discussion. And I'm just producing India's external balance sheet with the world to show you what, if you were kind of sitting here making policy, what choices would you see in front of you? So very quickly, when you see the external figures and you see the trade account, which is really merchandise trade, import and export, you can't help notice that a 6% deficit for a country of $3 trillion is almost $180 billion of a negative trade account with the rest of the world. And what it's therefore meant for the entire 30 years that have been around is that the exporters from India are always treated like, like we say in India, the son-in-law of the family. So you have to make policy which favors them. So whether it's the engineering exporters, it's the pharmaceutical exporters, it's the IT exporters, they have to do things to favor them. The second thing to notice, of course, in this is that oil is a large part of the imports because India is energy deficient. And this has been a big policy lacuna of the country, that they haven't invested enough in finding own energy reserves. And even when you go to renewables, despite signing deals like the nuclear deal, which came about in 2007 with US, or indeed the potential for solar energy, which is the much touted future of energy in the world, or indeed going down the path of electric vehicles and so on, ultimately powered by solar or other renewables, the country hasn't moved fast enough. So there is a place for opportunity. And the imports and exports, I'm just saying this quickly and don't misunderstand, it's actually a grossed up number, because for a country which is 65% services and only therefore 35% agriculture and industry, it is not possible that the exports are 12 on that 35. In other words, 1/3 of what India produces is not exported. And what this means is you're importing in product, for example, oil from the Middle East, processing it in, say, the Reliance refinery, and then re-exporting it back. Or you're importing in diamonds from other parts of the world, processing in India and shipping it back out. So the net number, I would argue, is probably half of this rather than the 12% number that you see. So in other words, exports are probably closer to 6%. Imports are closer to 12% because the value addition in all of the import, reprocess and sending out is not that large. And therefore, to create a 6% trade balance on a base of 6% exports is pretty much a very tall task to ask. And therefore, you would expect to see a lot more policies in favor of exporters out of India. The good news, of course, is that the trade deficit has not blown up the country because in the 1990s, we discovered something called software coding and exports. And the Indian software coders started then providing software services to the world. And that's the first line. And the second line was, of course, all the workers who went out from India to, including places like the Middle East and elsewhere in the world, who then send money back home to their families and aging parents and so on. So about 5% of GDP, which is a staggering number, it's about $150 billion flows back into India on the services front from its people, while it has a deficit on the merchandise trade front. So what this leads to, along with, obviously people from India will also remit some money out for their children's education, support of their relatives abroad, or indeed now to invest outside as well. You're left with a real net negative number of roughly 2.5% of GDP, which is about 70 billion odd dollars. And that's the number India needs to plug every year from rest of the world. And it has been receiving that by way of direct investments, private equity investments, and also foreign institutional inflows into the country, and a very small amount of debt flows as well into the country. So when you look at this, you can see how policy making will be dictated once you have an understanding of this sort of balance sheet of the country. And because, like I said at the beginning, they were very psyched by the experience of 1991, it's almost become a one-way bet against the Indian rupee that when dollars flow into the country, the central bank steps in to hold the value of the rupee and does not allow it to appreciate. And it sucks up that money by way of what it calls reserves and releases the surplus money back into the domestic market. However, the same money, when it flows out, the intervention is very meager, and therefore in every crisis you see the Indian rupee tumbling, and the CAGR fall against the US dollar has probably been of the magnitude of 5%. And any investor who comes in right now starts factoring that I need to make 5% extra to put money into India because I'm going to lose that much on the currency front. And in my view, this has been one of the mistakes of Indian policy making, because, and I'll show you in succeeding slides, that despite weakening the currency, it hasn't actually helped the exporters. And at the same time, accumulating these reserves haven't actually made India a much more attractive destination, because the problem lies elsewhere. And what it's actually effectively done is reduced the purchasing power and the profitability of India, and therefore its ability to reinvest and grow faster. But it's a debate which is perennial in the country. And I try in every forum to try and speak about this weak rupee policy. And when you compare with countries, even like China, which more or less remained pegged to the dollar and yet became export powerhouses, and productivity was forced on them and inflation remained low as a consequence, that was probably the choice to have been made, rather than this very easy policy of let's discount our price and hope we can sell more. A lot of you who are in business will know this from your sales team, who always want to drop prices to sell more. It actually never happens and it never works out. So just some data to show that actually, despite this weak currency, India's share of world exports did not grow. In fact, China kept powering ahead. And contrary to what people believe the opportunity would have come to India, Vietnam, of all countries, actually took a lot of market share. On a global context, if you think of Vietnam taking 0.5% of global market share, it's very significant, because the country's overall GDP is probably 0.5% of global GDP or thereabout. So it's led to very, very strong growth in Vietnam. And of course, Mexico and Ireland get the largest by being next to the United States and the European Union respectively, and very good tax treaties which they have, and trade agreements. And while the oil exporters, of course, lost world market share when prices went down, it wasn't commensurately matched by, again, India picking up any of that, despite it being a very oil intensive importer in the world. The other grouse, of course, we've always had in India is that the producers here have never managed to build scale. And even if you look at very rudimentary items, I'll first talk about apparel, which India is supposed to have a competitive advantage in that we grow the cotton, we have the textile machinery people, we have a lot of spinning capacity, we have a lot of people who can do garmenting, and they can export to the world. And yet, India's share is a minuscule 3.8% of the world market for traded goods in apparel and clothing accessories. And in fact, even Bangladesh and Vietnam are considered to be ahead of India. And this goes down back to poor policy, poor labor laws, and the such. And the more shocking thing, of course, for a country of this size with a fairly large manufacturing base, which can do a lot of steel, a lot of cement, to not be able to make its own tiles or its own sanitary fittings, its own lighting equipment, a lot of which continues to get imported from China, is fairly shocking and alarming. And again, I would say it comes down to the kind of business environment which is created. And the third one I again picked as a sample is, if you got 1 billion people, you would think you need a couple of billion pairs of footwear to be produced. And you would think intuitively people would go after that opportunity. And maybe that is something which people can pick up, listening to this, that this country cannot be only producing 2% of footwear of the world, despite having a population of close to now 1.5 billion people. So there are opportunities, but they've been hamstrung. And because there's not been a great profit cycle in the country, and the mentality of building scale, building your own brand, competing with the best of the world, rather than just becoming a service provider or a processor, that certainly kind of lack of confidence, in a sense, has been holding the country back. And the reason I find a lot of my friends, when I talk to them, that why are you not putting up more capacity, why are you not seizing it? It's really this, that the laws in the country seem to have kind of developed a life of its own. So even though it's 70 years post-independence, it is still run as a very oppressive kind of environment in which to do business. If you compare going and setting up something in Jebel Ali or anywhere in the UAE, compared to doing something in India. It's a complete nightmare of red tape. And it just foxes me why 30 years after we started liberalizing, instead of cutting these laws and compliances down and making life easy for business, this has kind of developed a life of its own. These graphs are produced by a friend from a company called Team Lease, and these are publicly available, and they keep updating what is going on here. So even after Prime Minister Modi has taken power now 6 years ago and promised to cut a lot of laws, this is the number after a lot of laws have been cut. So still very, very long way to go. And if you look at the state-wise breakup between the central and the state laws, it is just completely horrific. When I see it, I also kind of recoil. Even though I sit on a number of boards and we get these statutory compliance certificates from our people, to actually see the number presented in one go is quite staggering. The good news is that the number is now out there and everyone's attention has got focused that we've done something completely stupid and ridiculous over here. So being an investor and an optimist, one hopes that this will change dramatically. Of course, there has been a lot of effort made on making this ease of doing business. And India, I remember, used to be ranked like 150 or thereabouts. And over the last 4 or 5 years of Prime Minister Modi, they've brought it down to 63. But all of us in the business community here talk in terms of if you are aiming to be the third economy in the world, third largest, your ranking of 63 is not good enough. You have to aim to be number 1, 2, or 3 in terms of ease of doing business. And the rate of change has to be far more dramatic than what has occurred over here. And because I go back to this kind of vicious circle argument that because the laws, the taxation is so unfavorable to business, a lot of people have chosen to stay outside the tax net and the compliance net. And what India euphemistically calls the unorganized sector is not an unorganized sector. It's really an unaccounted sector. It's not that you're not organized if you're producing BDs or you're producing paints or you're producing jewelry and not paying your value-added taxes or you're not paying your corporate or income taxes. It's just that you're staying out of the net and transacting in cash. So even the much touted demonetization, which happened 4 years ago now, did not actually manage to unearth this. Even the much touted GST, which I'll talk about as we come along, where they try to harmonize all the indirect taxes of India into one kind of goods and services tax, which could prevent the cascading of taxes and just get charged at the end point. Even that hasn't really moved the needle a lot, because you need the combination of laws, compliances, and taxes all to go down dramatically to start bringing these people into the net. And I'll share as we go along that this has kept India in a very strange barbell situation where there are few very, very large companies and a plethora of very, very small, which are completely out of what you call the organized accounting system of doing business. And therefore, you've seen a lot of the middle getting squeezed between the large competitor and the unorganized guy who's not really paying taxes and therefore has that sort of advantage. And I mean, the graphs, of course, are self-evident that if you look at cigarettes, for example, they are taxed so high that there's a whole industry called BDs in India, which has sprung up. And shockingly, we have $1.5 billion of cigarettes now coming across the border from Nepal and Bangladesh on people who go on bicycles and find it very, very lucrative to just carry bundles of these across the border. For a lot of you who may be familiar with the jewelry trade and the amount of gold which India imports into India, it's one form of keeping your wealth outside the banking system. And it's been a store of value as the rupee keeps depreciating as well. And then as the lady of the house also uses her unaccounted money, pays to the unaccounted for jeweler, the whole cycle never actually comes into the whole tax bracket. So even though we've had a company which has created about a $12-13 billion market cap called Titan from the house of Tatas, you can see the scope of expansion possible if this trade does come into what we call the organized accounted sector. The flip side of this is that the Indian central government's profit and loss statement or cash flow statement, if I could call it that, also represents a bit of a horror story. That the country collects about 12% of taxes. So we get about 3% from personal income tax, about 4% from all the business tax, corporate taxes, and 5% from all the indirect taxes, which is all the GST, customs, and what we call VAT on product which are not in GST, which would include alcohol and petroleum. So 12% is collected by the central government, which is a very low figure. And if I just dwell on that for a minute, if you think of the GST rate in India, most of you will know it is 18%. And there are slabs, of course, few are at 4 and 12, some are at 28 and something even more exorbitant. But let's say the average rate would come out to somewhere around 16%. And we know they don't charge this by and large on agricultural produce. So 2/3 of India would pay 16% value added tax or GST on their output. So if you're paying 16% on 65%, you would end up with something like 11% should be the collection of GST in India. And 1 or 2% would come by way of customs duties. And maybe another 1 or 2% would come by way of the extra cesses and VATs and so on, which they put on alcohol and tobacco and so on. So you should end up with 15% coming from indirect taxes. And you would still have the 7% coming from your direct taxes on individuals and businesses. So you would end up with something like 22% should have been the collection as opposed to 12. And the whole unaccounted segment of society is not coming into the net. Again, it's chicken and egg that the tax rates are so high that you don't want to come in. And the cost of compliance is so high that it doesn't make it profitable for you to come into that net. So again, it's a problem, well known, well understood, and yet, year after year, you struggle that why doesn't someone get this? And why do we not have progress over here? And what that means, therefore, is when you go down to where do you have ability to spend money, you see that the cost side is fairly inflexible because of years of not having tax collections and borrowing. 3% of GDP, which is the equivalent of almost $100 billion a year, goes out by way of interest payments, which is completely unproductive expenditure in our poor country. And we are paying a lot of money for subsidies and salaries to defense personnel. Government administration itself sucks up maybe 2-3% of GDP and just paying salaries to their staff. And what it means is you have no money left for capital expenditure. So we look for, if you want to spend on defense to counter threats at the border, or you want to build highways or roads, you're completely out of money. And therefore you resort to funny things like, let me charge for telecom spectrum and effectively bankrupt that industry as well. Or with great anguish, there is this thing called disinvestment. Rather than let's privatize all the businesses that government is holding, which it has no business running. And I can't see why a government can run an airline better or a steel plant better or a hotel better than any private sector player. And what is the great value add they do by holding onto these assets. So there is a whole recast which gets forced onto the economy each time there is a crisis. And I, for one, subscribe to the theory that India reforms in crisis, and we're in the middle of a huge crisis right now. So what we saw, the big reform move in 1991, allowed India to move for the next 10 years. Then in the 2001-2 period, when the next Vajpayee government came, they had a series of reform which included privatization, opening up telecom sector, opening up to private banks and so on, which gave you a growth fillip for the next 10 years. The sad reality is between 2010 and 2020, despite parties across the political spectrum coming to power, we haven't really had that sort of path-breaking reform which could create new champions and a new energy in the country for fairly obvious things that needed to be done. So I'm hopeful that the COVID crisis is going to blow such a hole in the accounts of the government that there will be no choice but to bite the bullet. They've already announced tax reforms. They've already announced opening of APMC, the agricultural markets. They've already announced they want to privatize a lot more. They've already announced they want to get more people into infrastructure, and there'll be a lot of concessions made over there and so on. So I'm hopeful to see how this plays out, because it's often been a question of a lot of promise, but they're not followed up when you're crossing the T's and dotting the I's. And we see over the next 12 to 18 months how this plays out. And what this therefore has meant is also that the cost of capital has remained high in India. As the government borrows, it crowds out private investment. And with the rupee falling, the price that people put on Indian debt also then becomes higher. And it leads to a vicious circle, like I said, where it's uncompetitive for Indian industry to then put up capacity to go and compete with the rest of the world. The good news, though, is that the household sector is fairly unlevered. So people don't really have a big mortgage debt sitting on their heads. They don't really borrow a lot for consumption, for buying their washing machines or refrigerators. So the consumer finance business, the retail finance business in India, the investment management business in India, the insurance business in India has been a multi-year growth business and looks destined to continue to be so. The chart which kind of summarizes what I said, that because the policies went haywire and the cleanup of the Indian banking sector also coincided with this, the profit share of India, which is the BSE 500 here, which I'm referring to, went from a high of 7% of GDP to as low as somewhere between 2 and 3% of GDP. And normally you would expect an economic revival because people would be forced at the policy level. The central banks would cut rates. The government would have forced to cut tax rates to try and throw fiscal incentives. All of this was actually occurring in 2019, which made us very hopeful that we were at the beginning of an economic revival. Just then COVID hit. So it's kind of, you came out of a downturn, you were just going up and you got hit down. But what I see is what happens post this is that you're forced to reform and you're forced to give more concession to attract more investment and get the economy restarted again. So I see it as therefore I've titled it as, is it half glass full or half glass empty? Depends on your perspective of what your nature is, whether you're an optimist or a pessimist. But reality is, look, these figures are staring in the face to everybody. And I'll take a minute to just explain it in brief. These sloping lines, the yellow line, the red line, and the dark blue line are really the income curves of India. And when you think of most economies in the world, you tend to have a bell-shaped curve where there are few rich people, few poor people, and the bulk of the economy and the income earners are sitting in the middle class. In India, the first yellow line, which is very steep, is the number of poor people who were there in the year 2000, and a very, very shriveled middle class and an almost non-existent so-called rich class. By 2010, as I said, because of the reforms which occurred, there was a dramatic change where the number of people under the sort of line of what I call subsistence dramatically fell. You did see a rise in the middle class and an emergence of a new rich class. And the bubbles that I've displayed on top over here are basically three log scales. The bottom bubble reflects what you call the home mortgage business for $100,000 home, let's say. The bubble above that represents what you would buy for your transportation, let's say a $10,000 car. And then the bubble right on top is what you would call a $1,000 consumer durable. And if you see what occurred between the year 2000, which is the first set of bubbles, and the second set of bubbles, there was growth in almost every category. So the home mortgage business went from a stock of $9 billion to a stock of $90 billion. So it was 10 times in 10 years, which is like a 24-25% compounded growth rate. And this is what explains the love people have for the HDFCs and the home mortgage business in India. The second category, of course, which was cars and bikes, they exploded and they went up about 3 times in that period. So while it was volume growth of 10-11%, there was also value growth as prices went up. And the third category, which coming from a reasonably hot country, it was quite shocking. We barely sold 500,000 air conditioners, 2 million refrigerators. And that number also multiplied. Again, it ended up still with a very low number of 2.5 million ACs and 5 million fridges, but it was still very rapid growth. And this explains why at the beginning of the decade, when investors made their bet on India, they bet on the Indian consumer. So if you were sitting outside, you would buy stocks like Whirlpool, you would have bought stocks like Maruti, you would have bought Hero Honda, Bajaj Auto, HDFC Limited, and so on. And you ended the decade, 2010, while you made money, it was not because the businesses had performed, it was because the price earning multiples of these companies had gone up. Because frankly, the growth in each of these categories was very, very disappointing. So the mortgage business, which had grown 10 times in the previous decade, went up only 3 times in this decade, which was abysmally off target. Similarly, the car market, not even, I would say 2 million went to barely 3 million, although the figure is 3.5. It degenerated and people actually traded down. And instead of going up to buying Toyotas and Hondas, they went down to buying more Marutis and more Hyundais. And the bike market also, just barely 20 million bikes in a country of 250 million families, is again nothing. And for those who follow what's going on with the air conditioning market and refrigerator market, which should have been 3 times of the current size, we barely do 6 million air conditioners where we should have been at 18 million, just based on the income demographics of the country. So it's been a big disappointment in that sense over the last 10 years. So again, like as an investor, you can't complain because these companies' price earning multiples went up as people thought this J curve will come, it will come, it will come. But it's been elusive. And like I said, for reasons which included the wrong rupee policy of, completely wiping out purchasing power, importing inflation, keeping interest rates high, tax rates high, and the plethora of, policy which just kept everyone completely confused over here. So again, is it half glass empty, half glass full? Will this change? And if it changes, the potential, as you see, still remains, because the country, if I divide it into kind of 3 categories, is really 3 Indias. There is India 1, which we can compare to the Mexican level of per capita income. And it's maybe 10% of the country, which can afford to buy a car. The next 20% of the country can afford to buy a motorcycle. But the balance 80% of the country is probably on a bicycle or walking bare feet. And if you can get that 70-80%, what we call Africans, to become the Filipinos and then become maybe the Mexicans, that's really the hope, and therefore the high price earning multiples that investors from across the world have paid for India. But like I said, it's been disappointing. Now, whether this trend continues or we use the crisis to come out with greater reform and greater attraction in a world which is filled with a lot of liquidity now and looking for its next growth engine, that really is, the perennial debate in the country. What this therefore has reflected is like I said, the businesses got very polarized. The large became very, very large, and the small stayed out of the tax net and continued to run circles around the tax administration. And the middle has kind of vanished in the country. So if you look at this data, and I don't mean you to, look at the numbers over here, but if you look at it, the 7 or 8 top companies account for almost $500 billion of market cap. And the next 17 or 18 companies account for the next 25 percentile of India. So 30 companies pretty much cover half of India's market cap. And people often wonder how come the Indian stock market is going up while the economy is getting trashed. While one reason, of course, is the liquidity and the gush and irrationality on part of retail investors, the reality is that these 30 companies don't actually represent India. They represent the winners of India. And that is actually kind of blasting off. Because some of you, for example, would have followed the story of Reliance, that the onset of Reliance in the telecom sector and the retail sector has led to a wipeout of people on the other side. And thereby it's been a shift of market share, which is getting captured on this side. Similarly, if you look at the banking sector, is the rise of the HDFC banks and the Kotaks and the ICICIs and all of the world has been at the expense of the public sector. So it's really been shift of market share and valuations. So while if both had remained same, they could have been at this level. But what's happened is while one has been dying, the other has been rising. So there's been kind of a zero-sum game in that sense going on over here. I'll show you this in illustrative form, that basically these 5 sectors account for 70-80% of India's profit. And half of India's profit pool is still coming out of what we call basic materials and energy. Very, very similar to what you might expect to see in the Middle East with its dependency on oil. Of course, the banking sector has done reasonably well, but the powerhouse for India was, of course, the IT sector. But it's still only about 20% of India's profit pool. 45% of the profits are still lying with basic materials. And another 25% is coming out of banking. So these 3 sectors pretty much are taking away the lion's share of profit in the country. And while this whole hope has been on consumer companies, if you think of it, Unilever has been in India for 100 years and it barely makes $1 billion. Now, if you tell me with all their brands and all the expertise and all the top class management talent that Unilever has, if it can only produce $1 billion in India, would you not think I'm better off employing my talent elsewhere? Which is what been happening. So the Indian management has been exported to various subsidiaries of Unilever, including back to its head office and so on. And the picture, if I look at market cap, which is on multiples, is going to look very different. So if you keep your eye focused on the orange side, which was 45% of India's profit, the next graph shows you where the market cap lies. So 45% of profit is representing only 20% of market cap. And even there, it's 17% of that 20 is really Reliance Industries, because it's kind of making the transition now to becoming a new age kind of tech, telecom kind of stock. So it doesn't really sit over there. And people don't really pay a lot of value for that. And the consumers, which I showed you, which barely make 5% of profit, the big hope on the greens, if you see, that 5% represents 22% of the market cap. Because the hope is that these, the Africans will become the Filipinos, and the Filipinos will become the Mexicans, and the Mexicans will become the Australians. And that's really the multiple that people are trying to pay for over here. Again, to kind of demystify the whole thing again, 5 sectors make 70% of the profit of India. And of that, I've already shown you, disproportionate share sits with materials, IT, and financial services. And what is more alarming is that while these sectors might be representing 70% of the profit share, in almost every sector, the top 5 companies, whether it's even in the sectors which account for 3 or 6% of the profit pool, the top 5 companies are taking away approximately 80% of the profit pool. So again, very barbell, very large and very small players at kind of both ends. And having said that, the very large in India is not large by Indian standards. Because if you again come down to it, there are barely 19 companies in the country of this size which cross a profit of $1 billion. So the profit pool has sadly not kept pace with the rise of GDP. And that, like I've shown you, the collapse of the profits because of intense competition going on in the country. And like I said, very, very kind of difficult business environment as well. And even more staggering, even if I go to the next bundle, 19 companies make more than $1 billion, but it's not like the tail is suddenly exploding. There are only another 18 companies which make more than $500 million. So again, it comes down to there are like 30, 40 companies which are of some size on a global scale in a country of this kind of magnitude. And if you see bulk of companies, even on the BSE 500, end up in that 50 million type of dollar profit range, which by no means is something which is very lucrative to attract investments, particularly from global investors, or indeed inspire confidence in local investors, because then the governance requirements and the compliance requirements and the scale requirements and the execution challenges to go from 50 million to 500 million are not trivial by any means. So it is kind of remaining trapped in this kind of constant up and down battle. Just turning track briefly, while I've shown you sectors you could look at and what the policy options are likely to be, there's another angle I always like to follow, and I'm just sharing that we look for people who are in what I call the golden age of the age group 40 to 50. And over decades, and this may be a false correlation I'm trying to draw, but if I look back at the 1990s, where a lot of us made our money was in these 3 or 4 names, and the CEOs of these companies were in the age group of 40 to 50. And these companies compounded dramatically, and then it just fell off after that. If I go back to the decade of 2001 to 2010, 11, again, it was a new set of people who were in the golden decade. And again, it's not like all of them had a very inspiring lead up to it. A few of them were doing well, of course, but it's not like you anticipated what was coming next. And you realize when you compound 24% for 10 years, you end up making 10 times your money. And which is, even with a 5% rupee depreciation baked in, this is a very, very high rate of return. And you don't really need to weave in and out of the market. And these guys obviously then end up as becoming one of those top 20, 25 companies of the country. And the same story repeated even in the last decade, which we're just finishing now, that the people who are in kind of that golden age, and I think our analysts cheated a bit by slipping in a few people who are 49, 52, 56, maybe to prove the point. But I think the argument does hold that you're not in kind of the glory seeking age when you want to become like a statesman and you don't worry about profits and you're more concerned with being on the cover of magazine covers and getting awards when you're in your mid to late 50s. And equally, you're not the very kind of impulsive, aggressive 35-year-old who can bet the business, and even if it blows up, what does it matter? I can take a bet again. So there is something to be said about this theory, and I don't know whether it appeals to you, but it certainly helped us. And each decade, if you just got one or two of these right, it just made a dramatic change to all our portfolios. And a lot of the investors you find in India who are counted in the ranks of billionaires would look back to, we got Infosys right in the 2000s, we got the Reliances and the Bhartis and the Titans right in the 2010 period. You would have got the Bajaj Finance, the D-Marts, the Page Industries right in the previous decade. And that's just given a lift off to everybody's portfolio. Normally, I would have liked to have talked about market cycle, and maybe we'll come back to this. But I do think given what's going on in the world and the gush of QE going on, with interest rates being the force of gravity which dictate economic cycles, if the interest rates are now manipulated and kept to zero, that force of gravity has vanished. And therefore, this almost predictable market cycle that one could track and follow, I think has kind of got suspended. And we are living in a period of almost Alice in Wonderland where the economy and the markets are completely divorced from each other. So we'll see how this plays out. But to me, I'm certainly finding this represents more like 2001 bubble than a more sustainable kind of upturn in kind of the global leaders where everyone is herding into the same 5 or 10 stocks at the top of the market. Looking ahead, of course, while these are the listed companies, some of you I know may be interested in what's going on in the private equity space. And there is, of course, been a lot of interest. I myself was involved in that space for a lot of time. We now, of course, do it directly from our family office. And there are a number of companies producing unicorns and decacorns as well now from India. Over the last 10 years, of course, what I saw were a lot of copycats emerging. So people saw the Amazon model and they created a Flipkart. They saw the Uber model and they created an Ola. They saw the Airbnb model and they created an Oyo Rooms. And then you attracted capital from the likes of SoftBank and they kind of started getting built out. But what's pleasing is over the last few years, you're starting to find companies which are uniquely Indian models. There is, for example, Nykaa, which is a Indian version of Sephora, but online. There is something I was involved in called Lenskart, which allows you to buy your eyeglasses online and offline. There is something called Byju's, which has come and taken education online, and it's attracted investment from Disney and the like. There's a gaming company which has come out called Dream11, which plays into the Indian love for sports and betting around sports and so on and so forth. So there are interesting things coming in the consumer tech space, which one could get involved with as well. And of course, I've got involved in a number of companies on the health and health tech side as well, because I do think there will be a change from chemistry-based healthcare to biology and eventually to the gene therapy. And that's maybe directionally where one could start thinking of making more bets. And then as we get to a less fossil fuel world, what is going to happen with the advent of electric vehicles and solar and so on could also be very, very interesting. So there is some stuff to be done in the country, and there's a very thriving ecosystem in the private markets as well. So I just wanted to leave you with a few thoughts that number one, of course, the financialization of savings as the public sector, banking sector kind of loses its luster and sheen, it attracts a number of players which are going to do extraordinarily well. It's a 70-30 ratio between the public and private sector today in the banking side. And I suspect it will be completely flipped over in the next 5 years. Same thing could apply in insurance. Same thing could apply in mutual funds. Same thing, of course, has already happened in mortgage and consumer finance. And I think these trends will continue. And it's an interesting time because financials, which at one time were leading the market in Jan-Feb, are completely beaten and bashed now. And maybe next quarter when the moratoriums in India end, that could be an interesting time to see the bottom formation in some of these names over there. The second area I point out to is obviously the government is in severe stress and they will be forced to privatize a number of naturally monopolistic or oligopolistic segments. And if you will go back to when the first wave of privatization happened, tremendous wealth was made where Reliance had picked up an IPCL, Suzuki had picked up a Maruti, and the Vedanta group had picked up a Hindustan Zinc, and they were literally 100 baggers over the next 10 or 15 years, because the intrinsic value of these assets was very, very large. And they have announced they will put up BPCL, which is an ex-Burma Shell company in the petroleum space, which is coming out, Container Corporation, which is in the logistics space with the railways. So there are interesting companies which are going to come out, and I suspect there will be a lot of wealth creation happening there. Additionally, a lot of the government services are going to get privatized. Like we already have TCS handling the passports being generated and given out to Indians. The railways have announced a number of initiatives to get rid of some of their assets as well as services over there. There's already a listed railway ticketing stock, which has done very well because it's seen as a kind of internet play in the country as well. So there is something interesting to do there. There are, of course, platform plays which are alluded to in the healthcare, education, e-commerce space. And, I think that trend will only accelerate because of what we've gone through in COVID. And then lastly, let's not forget that big J curve of consumption, which has disappointed for the last 10 years, cannot continue in that path because the electorate will start voting people out. And therefore, I do think you will see a rate of change over there. And you should keep your eyes and ears open for that as well. So just quickly to summarize, the country had a great past, a terrible sort of last 200-300 years, started reforming and came back slightly back into right shape. And then since economic reform came, we have done reasonably okay, but a lot more remains to be done. And the world is focused on what kind of reform and what kind of opportunities India will offer. And a number of measures have come. And most investors have, of course, stayed focused on the entrepreneurs and the businesses that can create super scale in the country. So I think with that, let me just pause here and maybe take some questions for you.
Thank you. Thank you, Manish. So I think amazing analysis and synthesis, but you've gone really behind some of the headline numbers and analyze them in conclusions. But let me pick up the first one. You mentioned about exports and imports, how they've grown from exports from $18 billion to $330 billion and imports from 24 to 514. Now, the sheer gap, the huge rise in imports itself would suggest that, we therefore should not be importing inflation, especially after you have made the point that, keeping the rupee low is not particularly helping exports either.
That's right.
So I'm surprised why the policymakers that we, haven't, is it the power of the lobbies? Is it, simply a hope that exports may crash if, as a result of this, they'll be priced out of the markets? So what is it that is creating this?
Einstein had this lovely saying that the definition of insanity is doing the same thing over and over again and expecting different results. And we have seen now consistently that depreciating the rupee has not really led to any rise in your export market share. And in fact, you've got elbowed out of industry after industry. So the answer is kind of obvious, but I do think the way the policy has been kind of created, and we've got this silo of the Reserve Bank and the Finance Ministry sitting separately, the charter of the central bank is not, unfortunately, to keep a strong rupee. It's to keep inflation low. And in their mind, even though the economy is only, I would say, 20% organized and 80% unorganized, you can put interest rates up to 20% in India, and I don't think it will matter on inflation, because it won't do anything to agriculture, it won't do anything to imports, right? Because your imports are fairly inelastic. You're importing basically oil and essentials and capital goods, for example. So it's not going to really help you there. So it's some sense, and I'd written an article in Economic Times, which got some traction, where we said the generals are in fact fighting the old war. Because they all grew up with 1991, where we had to pledge our gold, they are so spooked that we must always at all times have foreign exchange. Now, we don't realize post-2008, $500 billion is being created by US and Europe every quarter. because they print $1 trillion or $2 trillion a year. So what are you calling reserves? It's just not reserves anymore. It's a bit like the military fighting the Second World War and saying we need aircraft carriers and we need guns. And the future is cyber and drone warfare. And you don't need those, aircraft carriers and destroyers anymore. Well, who's going to come and attack you frontally on that basis? So I think it's a bit of that when that regime changes and that age group will change, maybe that's the hope. And you do need direction to come from the top with someone farsighted. So we live in hope. Normally in the second term in a democracy, the politician transitions and becomes a statesman. And he thinks about legacy. So I'm hopeful that in the middle of this second term, while we missed it in the Manmohan Singh era, maybe we get it in the Narendra Modi era, that as they come to the end of their second term, they think more in terms of next 10 years rather than just winning the next election for their party. So let's see.
Particularly because, you've got a large investor base in this part of the world, both, as you mentioned, sovereign wealth funds like ADIA and ADIC and, ICD in Dubai and so on. But more importantly, there is a very large pool of pension funds, all of pension funds, insurance companies, large institutional investors, the NRI investors, all of whom keep having to factor in whether, not just a 5%, whether it in a particular year it might shoot up even higher. Well, 5% is an average CAGR depreciation, so to speak. So I think a country that needs FDI, and if you're going to have $2 trillion of spend on infrastructure, for instance, which is what has been estimated, you need a very significant amount of both debt and equity inflows. Absolutely. And FDI flows, not just foreign portfolio investors, getting into the secondary stock market, which just pushes up values, but you need people that will create companies, grow businesses and create jobs and the like. So that's not happening thanks to this policy, because, if you start, many of these businesses are so highly competitive that a 5% depreciation might, mean whether you're making money or losing money. So I think it's a debate that needs to continue, and hopefully
again, it's again, like I said, the generals fighting the old war. If you look at just these bubbles over here, Indian Oil, the National Thermal Power Corporation power plant, PGCIL, which is the power grid of India, Gas Authority, which is the gas pipelines of India, Coal India, which is the coal mines of India. Do you really think they will have a lot of value 20 years later? And if you are the government, you want these assets to be run as productively as possible.
Yes.
And it's not like even if someone from the Middle East owns it, they're not going to steal your pipelines or your power grid and they're going to not run away with it. If it can be run efficiently and you get a good price for it, you could take that money and create new assets. And the most obvious thing which we spoke, and I used to work at least in the 2003-4 period when they were privatizing a lot more pragmatic and forward thinking, they had realized that if we sell the old assets at say 2 times book value, and we deploy the capital into creating new assets at 1 time book value, and we keep selling, create at 1, sell at 2, and do that efficiently, that is the way forward. Even today, if the government gets rid of its airports, its toll bridges, its roads, there are enough people who are looking for annuity assets. One of my friends is just in fact listing his REIT for commercial offices and giving a 7.5% kind of yield. And the world is lining up to buy it. So surely if you get infrastructure assets in India, I'm sure it's not just the sovereign funds from the Middle East. You have the Canadians, you have the Norwegians, you have the Singaporeans, indeed even the Chinese, which may not be very welcome, but it's all looking to deploy capital. Because in a world with $13 trillion at negative interest rates, if India can even give you, high single digit, which means almost a 15% IRR, assuming a rupee depreciation, you'll still end up making 8-9% on a dollar return on these kinds of assets. They're yielding already 7-8% on dividend yield. So it's just poor economic management. But again, like I said, when you see it, you always say, now what? What next? And because they are in such a corner, in some sense, this COVID crisis, I would call it a silver lining, that the balance sheet is going to look so messed up that they will have no choice but to go lock, stock and barrel And in that time, you will have opportunities available for someone who's again not thinking, oh my God, these are PSU, Faltu assets, because you have to see what you can do with it rather than what they have done to it. So I think that time is coming and it's fairly imminent.
Yeah, I think the challenge is really leadership. You know, we've got very strong political leadership, very astute. But when it comes to managing the economy, the leadership on the economy, especially different sectors, for instance, you know, you showed about India having first or second in terms of agriculture base.
Yeah, yeah.
Now, certainly in this part of the world, but many parts of the world, food security is becoming a significant issue. So if they can line up, if they can own some of the food producing assets, you know, food parks, the various agricultural parks, etc.
So, Suresh, you said right, and I'm sorry I'm jumping a bit because I know your members may be already 1 hour into it. So it's like you rightly said, it's a political thing now, because when you will talk to the secretaries concerned, they understand that 45% of India cannot be employed in the farms. You cannot suddenly make your agriculture more competitive without improving the ways you do it. And you have to first go backwards into the crop, and you have to go forward into food processing and more value addition. And that cannot happen without both capital as well as expertise coming in. And for that, like I said, there's been a very important reform announced in the last month by the finance minister on the APMC Act and opening of markets. So it's already a step forward in that direction. There's already been this talk of the food parks and creating almost like you had SEZs for the export zones to create food processing zones. So like I said, stay tuned, because the crisis is so large that in a perverse way, we hope, like people are saying, the GDP of India will shrink by 10% this year. That shrinkage on a balance sheet which is so levered will force you to do certain things which politically would have been unpalatable. So I think stay tuned. This is the next 12, 18 months is going to be exciting times, I think, as an investor.
Let me quickly take a few questions from our members.
Sure.
Mr. Bharat Narayan Murthy wants to know what would be the fiscal deficit post-COVID. So therefore, would it lead to an increase in corporate taxation?
So I mean, the question is absolutely right. Every government in the world has blown their balance sheet. So India is not unique in that. In fact, if anything, they've kind of packaged what they call a 17% stimulus, which is actually not a 17% stimulus, because it's really more coming from the central bank, and in terms of, you know, we'll release liquidity and so on and so forth. So they're not taking a lot of hit on their balance sheet.
Sure.
But because your revenue side is going to shrink so much and your expenditure side is so inflexible, it's inevitable that the debt ratio of India, which is in the mid 60s, is going to end up closer to the 80s over the next 2 years. And it's inevitable, not just in India, but elsewhere in the world, that there are 2% guys who have money in India. So how do you extract more from this 2% has been the popular norm. So while the heart has been on getting tax rates down, and you saw them trying to cut corporate tax rates and try to cut the personal tax rates, the so-called notion of let's get this super rich, and super rich in Indian context is a guy with $1 million. So it's not really a super rich guy. Let's get them. And while they've resisted wealth tax, inheritance tax, and all that for a long time, I do believe in the world there is a move coming to get, you know, if you're sitting in the administration seeing Mr. Ambani just collected $25 billion and I got nothing by way of revenue, short-sighted view will be, let me try and extract something from there. The long view, of course, is let him create wealth and let it trickle down. But I mean, speaking from what I've seen, they usually make the mistake of looking at the short run rather than the long run. So he's right to be kind of alarmed with that.
Skeptical about what might be the case. He's also asking, you know, how come the stock market is booming when the economic parameters are so dismal?
So I did answer that. I thought that
you did. Yeah.
You know, those 30 companies are not actually the economy.
Yeah.
And they are really wiping out the rest of the economy and taking disproportionate market share. Correct. And also there's this Robin Hood crowd, which is, I can't put my money in fixed income. I can't do anything. So let me take a punt in the market.
Yes. The next question is, banking sector is very fragile with huge NPAs. Do you expect stock market to crash on the back of financial sector.
So the banking sector is an old problem, as you very well know. You yourself
Yeah.
were head of a very major bank.
Yes.
But what, like I explained, is the public sector is basically getting obliterated.
Mm.
And if you look at the major, 5 banks, HDFC Bank is well capitalized, and all these banks, HDFC, Kotak, Axis, ICICI, have all gone out and raised capital already, or are imminent to raise capital, and it's setting up for them to gain disproportionate market share. Which is why I said, I think Q3, when the moratorium ends in India, and these bank stocks are still beaten down and people are thinking they're going to be NPAs and all that surfacing, I think the reality will be worse than what people expect. And that usually gives you a jump up. And then if you look ahead 2, 3, 4 years, these 5 are going to start dominating the banking space in India.
True.
And therefore, it becomes an opportunity if you're an investor, that when things go from what I call terrible to bad, there's a rate of change with the market's price, and you get price action over there.
Correct.
So,
next question. Mr. T.N. Pratap wants to know which are the top 10 companies in terms of shareholder value for the next decade.
Actually, he's not getting that for free.
Yes.
But there are a lot of good fund managers. Of course, we are just a family office, and I don't offer any professional services or anything. But they are, and I thought I gave you enough indications of where to look.
You're right. Yeah.
Now, either you do it yourself, or you find there are a number of good fund managers in India now, where they can create and curate portfolios for you. Or you could go into the mutual fund. So, and even there, they have these focused funds where they just buy 25 of the top names. It should be interesting to look at some of those.
True. Mr. Atul Agarwal wants to know about startups. Are these huge valuations sustainable?
So it's not everywhere. What you're seeing is, of course, when it's like everywhere in the tech platform world, when you see a platform gaining traction and there are 2 or 3 players left, the popular view has developed that if you saturate them with capital, they disproportionately gain share and thereby end up becoming monopolies. Like I give you the example of the fight India had between Flipkart and what was then Snapdeal. Snapdeal, of course, died. Flipkart was acquired eventually by Walmart, and it was built hoping to be flipped to Amazon. And the big investor there was Tiger. But Amazon took the view that why the hell should I pay so much when I can spend the same amount of money and build it myself? And then SoftBank came and took a view that I could bring Alibaba through Paytm into India, and I can play the game also myself. And Jio has now taken the view that we want to come and play this game. So it's becoming a kind of big boys fight in different categories. There was a recent case of Zomato and I think a Swiggy, which were the delivery guys, where again disproportionate capital came and the rest have got wiped out. So it's becoming in sector after sector. If you get the 1 or 2 winners right, those valuations are basically pricing in then the next 5 or 6 years of what the winner will take from the profit pool. So that seemed to becoming the dominant theme.
Dr. Hemant Jetwani says, very informative presentation. He says with bank ratings and country ratings likely to see downgrades, what impact on the stock market?
You should answer, but people just think the rating agencies are like the police in the Hindi movie. They come after the crime has been committed. So the downgrade is talking about the past. And the markets are normally discounting the future. And India doesn't have a lot of overseas borrowing actually.
You're right.
In fact, it's very foolish that we may have 600 billion of overseas borrowing, which is your term loan. And then you have $500 billion sitting in your reserves, which is your current account, which is
earning 1.5%.
It's the most absurd financing I've seen in my life. So,
yes.
The rating is frankly quite irrelevant.
He wants a copy of the presentation, which, if you agree, we can share with.
Which you have in advance already. Yeah.
Yes. Yeah.
Some slides I added later, but I think the gist of it is all there.
Yeah. Maybe we'll pick it up from you and circulate it. James Matthew says, great presentation insights, even after 75 years of independence. We're caught up in red tapeism, complex tax system, fall in ease of doing business. He says, if you were to take up the position of Prime Minister of India, what would be your immediate action points? and the priority sectors?
So, A, I have no such aspiration. B, I think I did touch on the balance sheet and the P&L, and at least from an economic perspective, what
Yes.
needs to be done is fairly obvious.
Mm.
And we all know it's the politics playing out, because you unfortunately have elections every 6 months somewhere or the other in India. And you don't think you may get the political support. And which is why it is disappointing that this administration had a majority which they could have pushed things through. If you can put demonetization, which affects every single Indian, and you don't get thrown out, means you have absolute power to do what you want right now. So it's a question of mindset now, that I want to be a leader and I don't want to keep repeating mistakes of the past.
Correct.
Now, like I said, it happens in a crisis, because let's face it, we grew up in an economic world, in an economic paradigm, and we may think like capitalists.
Yeah.
These guys grew up in a political world dealing with the common man, and they may not have that, political or economic education. While the instinct is, more right wing, I win the election by being more left wing, and therefore it ends up with a muddle. So when events force you to where I think they are now leading them to, these leaders are in reality followers, and they will have to follow the trends which the world is dictating.
So Dilip Sinha says, what about investment, healthcare, and health infrastructure? Sadly inadequate in India.
I did mention that actually as
would that be attractive for foreign NRIs and foreign investors? FDI.
So actually, there have been people even from Middle East who've done well, who've also built up stuff in India. And whether it's Malaysia's Khazana, Temasek, we ourselves from TPG have put up a healthcare platform. So it is a sector which is of great interest to everyone, because that the public healthcare system is broken. And like you invested in private sector banking or insurance, airlines, and so on, every time you went against the government in a sector which they were dominating, the private guy created tremendous wealth. So it is a very, very interesting space.
Absolutely. Mr. Vijay Somani wants your views on the Middle Eastern economies in the era of low crude price and its impact on the world economy.
Nothing about it, so let me not try and act like I'm smart on everything. Pass.
Dr. Jetmani wants to know, will the government come up with another tranche of NRI bonds? I think
they don't need foreign exchange, actually.
They don't need, yes.
Unlikely.
Correct. No, I think that really completes the questions. Of course, there are other questions like, do we need a better finance minister, etc., which I think falls outside the realm of this evening conversation. Maybe.
I don't have any political leaning this way or that. We just want the right thing done.
Yes, absolutely. Thank you very much, Manish.
Thanks for having me. Hope it was useful.
Do you want to give us one or two words of, in terms of your closing comments? What do you think, as NRIs, leading NRI forum, etc. What we sometimes have the advantage is that when these visiting ministers, etc., come here, they're a lot more focused. They've got a captive audience and a captive, arrangement. So often we are able to push a policy agenda a little more forcefully than might be the case. There's a lot of din, and a lot of people are saying lots of things in India. So you need to rise above that noise level. Here,
if you can just help to do that, and one of the reasons I do these webinars, I really don't have any reason to do anything, because it's not like I'm looking for business or clients or anything. It's really to try and get this message out.
Yes.
Because John Kenneth Galbraith had said this very famously, that you need to keep the idea alive till the right moment comes.
Yes.
While maybe I wrote this in my MBA thesis some 35 years ago, the same ideas are probably true even today. Maybe the time will come where either me or my son or my grandson is going to see some of these ideas taken to fruition, and India competing and getting its potential. So while we can individually do well and make money, you just feel sad as an Indian that the country is missing such an opportunity. And where so many young people, like I showed you, 9 million jobs are needed every year. And it's a crying opportunity. There's capital available in the world, opportunities available, the consumer is there, the skill sets are there. It's just a question of mindset and leadership. And I just hope and pray that for all our sakes, that, we come out, because we don't want a world which is, US and China, and then we're kind of serving them. And there has to be a counterpoint, I think, in the world as well.
Hopefully sooner than later. And indeed, hopefully sooner than later, we'll have you in person here, live in IBPC. So let's hope, that even the COVID crisis passes and is behind us. And, we can start to, as a country, accomplish some of these objectives, I think, which is what is going to take us to the $5 trillion economy, or whether it is Atmanirbhar in terms of, producing what is needed, cutting down on imports and the like. So lots of questions, but, maybe we'll schedule it for another day. So this is whetting the appetite. Thank you very much.
Thank you. Thanks for having me.
Appreciate. And as they say, God willing, soon we'll meet. Thank you.